Hello, everyone. Thank you so much for being here today and watching this video. We truly appreciate you taking time to join us. My name is Patrick Fross. On behalf of the entire team at Fross and Fross Wealth Management, we would like to welcome you to our 2025 Fross and Fross Wealth Management Halftime Report. Today's presentation is entitled Swinging Through Financial Uncertainty, Smart Plays on a Risky Fairway. And it's a fitting theme as we navigate an economic environment that's been anything but predictable. We'll be covering a range of important topics from tariffs to taxes to the broader economic outlook, as well as the strategies we're using to help protect and grow your wealth. In addition to my portion of the presentation, we're excited to be joined by our very own portfolio strategist, Tucker Woods, and our keynote speaker, Paul Peterson, Vice President with First Trust Portfolios, who will be providing an in-depth look at the market and the economy. So once again, thank you for being here. Let's get started. And we'll begin by taking a look at the disclosures, those exciting disclosures to keep the attorneys happy. Basically, this tells us that there is no perfect investment. We're not going to make any recommendations about a stock or a bond or anything like that today. So nothing said here is be considered a recommendation. And if you have any questions about the disclosures or would like to discuss your personal financial situation, please see one of the advisors here today. So back in February of this year, we held our State of the Markets meeting and we went through some of our observations and forecasts on how we thought some of the policy changes being put forth by the new administration was going to play out. So let's talk about what we got right, because if we're ever right about something, be assured we're going to let you know about it. So we talked about some of the potential headwinds facing the year, the economy, the market. And one of the first headwinds that we brought to your attention was none other than Donald J. Trump. And why is that? Well, Trump was talking taxes. He was talking, or tariffs. He was talking about this something that's unprecedented. We hadn't gone through this in decades, and no one knew what was going to be the effect of tariffs, reciprocal tariffs happening with all these trading partners. What about his talk about cuts in government spending? What was that going to do? What about potential job cuts in government? A change in immigration policy, mass deportations. What was that going to do to the economy? No one knew. What about AI? All the hype around AI. What if it did not materialize? What about potential tailwinds? Well, once again, none other than Donald J. Trump. One of the biggest potential tailwinds we could think of. And what were some of the reasons? Well, number one, Trump is Trump. Who knows? He's the wild card. Could there be increased productivity in the labor force? What about if economic growth outpaced government debt growth? What if the government ended up being more efficient due to reduced regulations, less government spending? And what if AI did lead to more corporate earnings? So there were so many things to look at, both headwinds and tailwinds. It was really a mixed bag. How did this all play out? So far, as we got to the halfway point of the year. We're in August now. So far, how did all of these forecasts play out? Let's talk about what we got right. Yes, the Karate Kid. 1984 gave us Mr. Miyagi, a beat-up yellow car, and the timeless lesson that repetitive manual labor is actually elite martial arts training. Well, fast forward to recent history, and we've got our own modern Miyagi moment with President Trump channeling his inner sensei, but instead of wax on, wax off, it was tariff on and tariff off. One week China gets a roundhouse tariff kick to the face, and the next week he's like, just kidding. Well, markets were ducking, dodging, trying to figure out if we were in a trade war or just an extended training montage. But just like Daniel, the Karate Kid, the market eventually found its balance, and turns out there was a method to Mr. Miyagi's madness. And in the end, it had an impact, and things seemed to be working out better than many expected. Now, fast forward to April 9th, 2025, when President Trump dropped the ultimate investment pickup line of all time. In one Truth Social post, he said, "This is a great time to buy." He posted that just hours before announcing a 90-day pause on reciprocal tariffs, except for China, of course, which faced a dramatic increase to about 125%. But what happened next? Well, the S&P had just hit its low point on April 8th, and then it shot up 9.5% the day of the tariff reprieve, making his timing look eerie. So Trump may not have taught us wax on, wax off like Mr. Miyagi, but on April 9th, he effectively said tariffs off and stocks on. So let's talk about what we got wrong, what we weren't right about. And it's time for a little humility. At our February meeting, we said Doge could have a material impact on government debt and deficit spending. Well, here we are in August, and let's just say so far, Doge is doing more barking than biting when it comes to fiscal responsibility. No real movement out of the debt, no meaningful deficit shift, no signs that Washington's replacing the dollar with the Dogecoin anytime soon. So this is part of our commitment. When we get it right, we're going to tell you. Trust me, we'll tell you when we get it right. When we miss the mark like we did here, we will own it and we will adjust accordingly. So we would be remiss if we didn't talk briefly about the One Big Beautiful Bill Act. I know there was a lot of hype about this going into summer, May, June. He wanted to get it passed by July 4th. In fact, at the very last minute, it was passed, but now we're not hearing much about it. So let's talk about some of the features of the OBBB Act that may affect you. As seniors, there's a lot of moving parts in this bill, but we just pulled out a few that may affect you. Number one, the tax rates from 2017 were made permanent as of 2026, so that's good news for most of you. Also, the standard deductions from 2017 were made permanent and were raised in 2025. These are inflation indexed, so currently it's $15,750 for singles, $31,500 for joint filers. Also, the estate tax exemption, okay, it was going to sunset, but now it's permanently raised to $15 million in 2026, also inflation indexed after that. What about no tax on Social Security? This was one of Donald Trump's campaign promises. He campaigned on this, but unfortunately he was not able to get that done per se. Congress would not play ball when it came to no tax on Social Security, so instead they came up with a compromise. They added a deduction for those 65 and older, and they're eligible. It's $6,000 if you're married, $12,000 deduction. This will eliminate taxes on Social Security for about 80% of Americans, and this is a temporary provision, and it does expire in 2028. So let's talk about the state of the U.S. economy. What's going on? What are we seeing from Fross and Fross Wealth Management? Well, back in January, the CNR Rockdale speedometer showed a relatively balanced economic picture. 9 of the 20 leading economic indicators were green, 9 were yellow, and only 2 were red. So equity market valuation and geopolitical risk were red. Fast forward to July, we see a clear shift. Only 2 indicators remain green: fiscal policy and credit demand. The rest have weakened. They've turned yellow from green, with equity market valuation and geopolitical risk still in the red. But, to be fair, geopolitical risk is it's a constant concern. Okay, that'll probably always be in the red. If it's ever in the green, I'll be shocked. But stock valuations are elevated. It is in the red, and it is no surprise. We're currently at 22 times earnings. That is expensive, and so that is a concern as well. So what's important about this? Well, while the overall outlook is softened, our analysis doesn't suggest an imminent recession. We may see slower growth, weaker earnings, low GDP figures, but we don't expect 2 consecutive quarters of negative GDP. That means a slowdown. That does not mean a full-blown recession. Okay, so if there is a recession, we think it's unlikely, but if it does happen, we think it'll be mild. And that brings us to our next point. Even when the near-term outlook is uncertain, what ultimately matters is how your portfolio is structured based on your time horizon. So, for example, we've shown you this chart before, you've seen it, but it's important that we bring it up again. We do not believe that all of your money should be managed the same way, especially for those of you that are taking distributions from your portfolio. Why is that? Well, it's because if you look at the chart, in every 1 year rolling period, the market's up 77% of the time. Basically, what that means is 3 out of 4 years the market's up. Well, that means on the flip side, 1 out of 4 years the market's down. We don't know when that's going to happen. It's unpredictable. It could happen at any time. So the danger is if the market's down and then you need to take a distribution, what if we had to raise cash? What if we had to sell assets? That's hard on a portfolio. That's called sequence of return risk, and we want to avoid that at all costs. So what do? Short-term money, we keep it conservative. We're going to keep 1 to 3 years of distributions in money market, CDs, treasury notes, structured notes. We're going to keep it conservative because we never want to have to sell at the bottom of a market correction. But if you fast forward to 5 and 10 years, the market's up over 90% of the time. Over 10 years, 97% of the time. So why would we be conservative with long-term money? We would not be. And that's why we do what we call the buckets of money approach. See, it's all about thoughtful planning, matching your money with your timeline, adjusting as the world changes around us. While no one can predict the future with certainty, what we can do is respond to the data we have and make informed, strategic decisions to help protect and grow your wealth. This chart nicely shows it. Now money should be conservative, and later money, long-term money, should be more aggressive. And that is one of the strategies we use to help protect and grow your assets. So to talk more about the specific strategies we've used and how we've navigated recent market conditions, I'd like to bring up Tucker Woods. Tucker is a certified financial planner professional and our firm's portfolio strategist. He's a graduate of the University of Florida with a degree in finance and a minor in real estate, and he holds his Series 7 and 66 licenses with LPL. Prior to that, Tucker was a graduate of the Villages High School, where he graduated as salutatorian of his class, which means Tucker was number 2 in his class. But I bet the valedictorian, I bet he didn't play football like Tucker did. So that's pretty impressive. Number 2 in his class. That's awesome. Tucker plays a critical role on our team. He handles trade execution. He conducts in-depth research that supports our advisors in making portfolio decisions. So please join me in welcoming Tucker to the stage.
Thanks, Patrick. Hello, everyone. I want to start by thanking you for taking time out of your day to listen to us. We know that you could be anywhere in the world doing quite literally anything right now, and yet you chose to be here with us today. So we wanted to say thank you for that. As Patrick said, I'm here to discuss some of the model updates that we have made throughout this year and the investment committee's reasoning behind these changes. I think before we start, it's important to note that any decision is not being made by one single person. We believe it's paramount that we work as a team, which is why any decision is made only after a rigorous voting and debating process. So we have 6 members on the committee, and each one is required to provide their views and vote before any decision is made. So with that being said, let's set the stage for coming into this year, 2025. The market had just come off of outstanding back-to-back years, returning over 20% in each of those years, so 2023 and 2024. While it was excellent to see, the committee wanted to dive deeper and see if history could provide us with any clues as to what we could expect to see from markets in 2025. So if you have attended any of our presentations like this before, this chart probably looks very familiar to you. What this chart shows is it shows annual intra-year drawdowns as well as the final calendar year returns of the S&P 500, and this chart dating back to 1980. So what this chart shows is that on average, the S&P has experienced a 14% drawdown in any given year. 14% drawdown is not fun by any means. Nobody likes to experience volatility, but we can see on average since 1980, the market has drawn down 14% in any given year. Even though it was the average, the S&P still finished positive in 34 of these 45 years. So why do we show this chart? We show this because we expected volatility to present itself this year. And even though we expected this, that doesn't mean the market necessarily has to be down on the year. So let's take a look at 2023, for example. The market declined 10%. But yet it finished up 24%. Similar story in 2024. The market had a drawdown of 8%, and yet it finished up 23%. Given our expectation for volatility, the committee voted to reduce risk in our qualified models, specifically our traditional models. So for traditional models, think of your IRAs, your Roths, or any other qualified accounts. What we voted to do in these models is we reduced risk specifically by approximately 7.5%. We elected to not do these trades in non-qualified accounts to limit any potential capital gains from selling. So let's take a look at some of the trades that we made. So the first one that we did is we swapped out our 10% buffered equity position for a 15% buffered equity position. So let's give a high-level overview of how these funds work. Everything's on an approximate basis, obviously. So think of over a 1-year time horizon. On average, the 15% buffer will approximately absorb the first 15% of losses in the S&P. Again, average approximations. But the reason that we added this fund and swapped from a 10% is because we expected to see some volatility coming into this year. Some other areas that we decreased our weightings to were large cap stocks, technology, and mid caps. The reason, it's exactly what we talked about, to reduce risk in the portfolios given the expectation for volatility. So now let's fast forward for a second. Let's go to April 2nd. Does anyone remember President Trump standing at the podium holding that massive poster with all those reciprocal tariff rates? I know we sure do. These rates spooked global markets, but it wasn't the fact that he announced these tariffs. Remember, all throughout his campaign trail, he said he was going to implement tariffs. He campaigned pretty heavily on that. But the shock came from the high level of these tariffs. So now let's take a look at how markets responded to the increase in tariffs. So this chart, the line in white shows a proprietary Bloomberg index that tracks the overall effective tariff rate for all trading partners that the U.S. does business with. The blue line represents an average of U.S. equities. So while April is an obvious outlier in this chart, and we'll get to April, we kind of see the pattern start in March. Remember, in March is when President Trump announced tariffs on Canada and Mexico. We can see a direct correlation to the effective tariff rate and equity movements. So what we see is as tariffs increased, equities decreased. And we saw this trend continue into April, where the tariff rate skyrocketed up to almost 30% and equities fall straight down. One thing to keep in mind is the rhetoric coming from the administration at this time. They continually said that for far too long, the U.S. has been treated unfairly in terms of trade, and these rates are here to stay to rebalance global trade. They said there's going to be no negotiation, and these are the end-all be-all rates. And this is what countries will pay to do business with the U.S. So let's set politics aside for 1 second. We can debate pros and cons of tariffs all day long, but let's look specifically at how markets responded to these initial tariff rates and what would have potentially happened if these rates would have stayed in place for a prolonged period of time. We see the correlation between the rise in rates and the fall in equities. And due to these trade headwinds and the discussions coming from Washington, the committee elected and again voted to make changes to the portfolios. So this set of updates includes all qualified and non-qualified models that your Fross and Fross investment committee manages. We have other third-party models that are managed by other investment managers that were not touched. This was specifically the models that the investment committee manages. So some of these models, you might hear your advisor talk about a traditional model, a tax-efficient model, ETF, American funds, blended, or IQ. All of these models were included with this update. The main theme of these trades was to reduce risk and add protection to the portfolio. So we reduced the risk by approximately 20% across all the portfolios. So let's think of it like this for a second. Living in Florida, we're all used to summer storms. Sometimes we're going to get heavy rain, sometimes there's going to be bursts of wind, and sometimes lightning strikes. Even though these storms hit, we typically don't worry about our house, since we know that our house is built to withstand these storms. Now let's take it a step further. Living in Florida, we are also very aware of the impact that a hurricane can have. When we see that we are in the path of a Category 3 or a Category 4 hurricane, or even worse, we prepare our homes more than we do for a normal summer storm. We might put sandbags by the door. We might board up the windows. We might move furniture from our pool deck into the garage. Why do we do this? We do this because the storm has the potential to do more damage, so we need to take extra precautions. This is exactly what the committee did and discussed whenever we voted to make these changes to our portfolios. We saw there was a potential for a storm coming down the pike, and we took some extra precautions to lessen the damage if that storm were to hit. So now let's take a look at some of the specific trades. First of all, we removed small caps from our portfolios. There were two material changes to our investment outlook that caused us to remove these small caps. First is that rates were not coming down as anticipated. Remember, late 2024, the Fed had started cutting interest rates, and the market expected that cadence to continue. But rates were not being cut. And we still continue to see that trend play out today. It is beneficial for small caps to have these lower rates because they have to go and get loans to finance. So you think of a larger company like Apple, for instance, that has a lot of cash. They don't need to get as many loans, and if the loan's at a little bit higher rate, it doesn't affect them as much. But you have a small mom and pop store down the road that has to go to the bank to get a loan to be able to finance their operations. That is going to impact them more if rates are higher. So with these rates staying elevated, that is a major headwind to small caps. The second material change is directly related to tariffs. Small caps did not get the same carve-outs that certain companies and industries did. So think of Apple with their iPhones getting a carve-out, the entire semiconductor industry getting a carve-out of tariffs, meaning that they weren't included in those reciprocal tariff rates. So due to this, these small cap companies were forced to absorb the full amounts of the increased tariff rates, which is another major headwind for the space. So you have increased borrowing costs with the interest rates not coming down, and you have increased input costs as well. So input cost is based on the tariff rates. So basically expenses are higher. That is a huge headwind for small caps. We also reduced our weighting to large cap stocks, technology, and global stock funds. The reason that we reduced these positions is specifically due to the elevated tariff levels that would have drastically hit corporate earnings. And think about this. Earnings have been what has been holding up the markets and driving those two excellent years in 2023 and 2024. Earnings have been consistently beaten by some of the largest and best companies in the world. If this earning dominance of these large companies would have been in jeopardy, who knows what would have been the backstop for markets to prevent an even further decline than what we saw. So now let's talk about what we added to. We added to gold, short-term treasuries, and a global balanced fund. Why did we add to gold? Gold has a very low correlation to the S&P. All that means is that the market movement does not determine what gold does. So some days gold's going to be up and the market's going to be up. Some days the market's going to be up, gold's going to be down, and vice versa. That's what's called a non-correlated asset. Non-correlated asset is where investors flock to in times of heightened volatility. And we saw this directly play out all throughout this year. And that's evidenced by gold hitting record high prices this year. We then added to our global balance fund for the reason that this allows us to determine where we wanted to take our global risk. The fund that we used specifically had a lower allocation to Asia, which, remember, as Patrick mentioned earlier, China had the highest reciprocal tariff rate out of any trading partner announced. So now let's fast forward to April 9th. Just shortly after that Truth Social post that we saw earlier, President Trump announced that 90-day pause on all tariffs to allow time for negotiation and for deals to be made. Keep in mind, this is a major reversal from the administration's initial stance of we're not going to negotiate, these are the set tariff rates. What we believe is that Treasury Secretary Scott Bessent pulled President Trump to the side and informed him that the reaction was much worse than they could have anticipated. And if this trend were to continue, the global economy was at risk of breaking. Thus, President Trump initiated the 90-day pause. With this new policy reversal being announced, as well as the outlook for the U.S. being willing now to come to the table and negotiate, the committee voted and approved a reinvestment plan. So let's take a look at that reinvestment plan. So we voted to enact a dollar cost average plan. All that means is that we're adding calculated risk to the portfolio in a systematic manner. What does that mean? So we took 20% of the risk off in April. So then we're adding back approximately 1/4 of the risk, so 5% every month for the following 4 months. Why did we do this? Because we still believe that there were some headwinds in the economy, such as who would come to the negotiating table, what the terminal tariff rate would end up actually being, and if the administration would revert those tariff rates for those who didn't strike deals back to those Liberation Day levels that shocked markets. Given these headwinds, that's why we elected for the dollar cost averaging approach to mitigate some of those unknown risks in terms of timing the market. Some of the specific trades that we did were adding to large cap growth and technology. What we saw as corporations announced earnings following the tariff announcements is that companies were not willing to compromise on their AI spending. Even if tariffs would have increased their expenses, the largest companies were willing to take lower earnings to be able to continue to spend on AI and broad growth development in general. In this current landscape, we are still seeing companies continue to blow past earnings expectations, as is evidenced by this quarter's earnings. And they're continuing to spend hundreds of billions with a B, hundreds of billions of dollars on AI development, showing that they believe AI is here to stay and it is important for the future of the economy. What else did we do? We also added to pure international stocks as opposed to global stocks. The reason being is that international has underperformed the United States for the past decade. This has caused these international stocks to look extremely undervalued. We also have seen massive inflows to international markets. Why is that? Because what April caused investors and institutions to do was to completely reassess their allocations. And what they found is that they were severely underweight international stocks. Let's take a look at this chart here. This chart is VXUS, which is the Vanguard Total International Stock Market ETF. What this chart shows is that all throughout the volatility of this year, all throughout April, the highs and the lows, the maximum drawdowns, the fund saw consistent net inflows all throughout the year. The obvious outlier is down at the end of July, which we interpret as these flows do not appear to be done yet. We expect this trend of institutions and investors reallocating a portion of their portfolios to outside of the US is a trend that will continue for the near future, which is why we're continuing to add to this pure international fund. I'll leave you with one final chart. It shows that there are still reasons to be optimistic in this market. So what this chart shows is it shows the S&P performance after closing 60 consecutive days above the 20-day moving average. All that means is that you look at the closing price of the S&P for the past 20 days, take an average of it, and if the current price of the S&P is above that, you're above the 20-day moving average. This has only happened 8 times since 1950. And on July 21st was when the S&P closed above the 20-day moving average for the 60th consecutive time. So now let's take a look at 3-month, 6-month, and 12-month forward returns following this. The 3-month was higher 8 out of 8 times. The 6-month, 7 out of 8 times. And the 12-month, 7 out of 8 times. What does this show? This shows that bull markets are resilient. And given this resiliency, we continue to see optimism throughout the markets over a long time horizon. This is another confirmation as to why we are comfortable adding risk to the portfolios. Look, we know that volatility is never easy to stomach. It's difficult to see values increase and decrease, sometimes by a large amount. What this year has showed us, though, as Patrick said, the importance of having a financial plan and having your short-term income needs protected. In spite of this volatility, we still continue to see bright spots in the market that give us optimism for the long term. This is evidenced by corporations continuing to spend on AI and continuing to spend on broad growth and continuing to beat on earnings expectations. With the theme of this presentation being swinging through uncertainty, how many of you have ever stepped up to the tee, as confident as can be? You're standing over that ball and you're ready to hit a perfect drive. And then inevitably what happens? You pull your drive way offline. How many of you has that ever happened to? I know it's happened to me, way more than I would care to admit, but it's happened to me. But then isn't it such a good feeling? When you go, you drive your cart, you find your ball in the rough. You look at it, you judge the lie, you pick your club, you swing the same swing you've practiced over and over again, you trust your practice, and you stick your second shot to 6 feet to give you a great look at birdie. We believe that's the exact way that markets have acted this year. The beginning of the year was that pulled tee shot. And then we saw the spectacular recovery in markets that is like that iron shot that you stuck to 6 feet. Now we're on the green. And what do you do as soon as you get on the green? You look at the putt from all different angles. You try and see the line. You try and read how much break to anticipate. You decide whether it's uphill, downhill, and how hard you need to hit the putt. You read it, and now it's time to execute, roll the putt, and drain it. Thank you for the trust you've placed in us. We don't take it lightly for 1 second. You guys are the reason why we do what we do every single day. Thank you. And now I'll turn it back to Patrick.
Thank you, Tucker, for that insight and for the work you do behind the scenes every day to help guide our portfolio decisions. Your technical expertise and dedication to research plays a vital role in how we serve our clients. At our firm, we don't rely solely on internal resources. We believe in surrounding ourselves with some of the best minds in the industry. One of the research partners we lean on heavily is First Trust Portfolios. They've built a strong reputation for thoughtful economic and market insight, and were awarded the Forecast Accuracy Award from Consensus Economics in 2022, an honor that reflects their consistent ability to accurately analyze and anticipate market conditions. Representing First Trust today is Paul Peterson. Paul is a vice president with First Trust Portfolios, where he works with financial professionals to implement unit investment trusts, mutual funds, and ETFs into their practice. With over 20 years of experience in the financial services industry, Paul is known for delivering industry-leading commentary, portfolio analysis, and practice management guidance. He's a graduate of Loras College, where he earned a degree in mathematics and education, and we're proud to have him with us today. Please join me in welcoming Paul Peterson.
All right, good day, everyone. Hey, thank you so much to Fross and Fross for having me here. I'll give you a little bit of background on myself. Here we are. We're now halfway through the year, a little more than halfway through the year. The S&P is, as of last night, up about 8%. And has anything happened this year? I mean, just curious, right? We've had trade wars, we've had elections, a lot of things have happened, and here we are. If we were just blind at the beginning of the year, we're up 8% on the year. So I've been working with Fross and Fross now down here in Florida for 23 years. Our head economist, you've actually probably seen or heard on either Bloomberg or Fox Business or even CNBC, but Brian Westbury won Economist of the Year in 2022. We were one of the very few firms out there saying that inflation is not transitory. Think about the definition of inflation. Inflation is too much money chasing too few goods and services. And we increase the money supply by 50%. And our firm is in the camp, well, if we increase the money supply by 50% and we don't increase the products or services, guess what? You're going to have inflation. And more than 90% of economists got that wrong. And we wish people would have taken Economics 102 because that's what drives inflation. So Fross and Fross can use different research. They utilize our firm because we are privately held and we kind of say what we think. So here's what we're going to do. Here we are up 8% of the year. And I just want to remind everybody on the screen, I always bring this up because emotions drive, unfortunately, some investment decisions. And 3 times a year, if you notice, the market does lose 5% of its money. So I think about this. If you have $1 million invested in stocks, right, and it goes down 50,000 in a week, like, that's never fun. Like, it happens, though, 3 times a year. And then, of course, you lose 10% of your money every 16 months. In fact, almost once a year. And this is when I get a phone call from my mom, right? Like, if you have $1 million account and you're down 100,000 in a couple weeks, that's never fun. But if you think about our investing 101 says buy low, sell high, I don't see too many people picking up the phone when there's panic. And you see every 5 years, you typically have a 20% drawdown we actually had one this year as well. So it's never fun to go through, but it is part. And I remind people, we have gone straight up since April. And for us to have a 5% drawdown from here until year end, it's certainly possible. So I want to remind people about that. But here's the good news. Volatility is the price you pay for long-term wealth. And I think of this, we were just talking to the Frosses earlier today about, the hottest company in the news is NVIDIA. NVIDIA has had 50% corrections over the last 8 years. So think about this. If you had $1 million and all of a sudden it turned into 500, it's never fun to go through, but you hit new highs every time. So we're going to talk about things in the news. This is an important chart just to remind people of things, because I always get these talks from clients about, well, what if China invades Taiwan? And the fact of the matter is, if China invades Taiwan, markets will fall right away for a little bit. But then a year from now, it will probably be lost in the news. And I think about Russia, Ukraine. Think about how many people were telling you inflation's going to skyrocket, oil prices are going to go up, gas prices. And where are gas prices today from a few years ago when the war started? They are lower. Why do we always start in the lower left-hand corner and end in the upper right-hand corner? And it has to do with a couple things. Listen, you will still brush your teeth no matter what happens inside the world, right? You'll still use toilet paper. You'll still pick up your iPhone and check the news. At the end of the day, you're not going to stop doing your day-to-day functions. So I want to be in the business of working on more people in the world that I can sell my products to. And I think about what drives the market long term. It's a couple things. Number one, population growth. I want to be in the business of selling to more people in the world. There's 3% population growth in the world. Are there areas where there's not population growth? Yes. In fact, if you look China over the next 20 years, population is going to go down. The largest demographic in the world, though, if you think about country, is India. Today, it's 1.6 billion, growing at about 2% population growth. Think about the continent of Africa. The continent of Africa last year grew at 6% population growth. So over time, the world, right, has about 3% population growth. So that's number one. So I want to be in the business selling to more people. Number two, the second thing is we want to buy businesses that can raise prices with inflation. Historically, inflation's 3%. So if I add 3% population growth and 3% inflation, guess what? That's 6. And then companies that pay a dividend, there's another 2%. And then a company that can buy back shares, that's another 2%. And let's just do this. Let's add those 4 things up. 3 plus 3 plus 2 plus 2 is 10. What is the stock market long-term average? 10% per year. That's why historically markets go higher. Now I think about what's in the news, right? Tariffs, right? We have announced them. Liberation Day, April 2nd. This is the first Trump administration. And what you'll notice is we started announcing or talking about tariffs in December of 2017. If you started with $10,000 and you just ignored everything throughout the next 2 years, you ended at $12,500, right? So you increased your return in essence by 20%. That's 10% annually. Yes, you would have had volatility along the way, but 10% per year is still a good return. And that's kind of our mindset here, is you have to ignore some of the short-term things that happen inside the stock market. And you need to look at the vision, the long-term, and where are tariffs coming from? I think that's an important topic. And again, regardless of which political side you are on, let's not talk about politics. Let's just talk about where were we at the beginning of this year. So this is a great chart to show you where tariffs came from and where the information that Trump has been putting out is. But on average, so think about this, we charge countries 3.5%. Again, this is before tariffs were announced. 3.5%. So if you're India and you make an item, let's say a car or a boat or anything, right, and you ship it to the United States, we charge you 3.5%. Now, all of a sudden, we manufacture something here in the U.S. and we create this beautiful product and we send it to India. India charged us 18. And then vice versa, if we sent our items to China, they charge us 7.5% on their shelves. And then you come back to the United States, we charge 3.5%. You can see where somebody in politics says, well, maybe this isn't fair, right? And we'll talk about other things, but at the end of the day, this is where it stems from. On top of it, we all know we have a lot of debt. Okay, so we're going to talk about debt here in a minute, but let's just think about this. People have been saying on TV now that inflation is going to be sticky and all of a sudden tariffs are going to increase inflation costs. And by definition, right, prices may go higher, but let's just think about what causes inflation. Think about the definition. We all know supply and demand is what drives prices, correct? So if you have more demand for something, it's going to drive up the price. You have less demand, it drives prices down. But we also know if you have too much money chasing the same amount of goods and services, that's what causes sticky inflation, right? So let's talk about this scenario, and let's talk about in 2020. This is very important because in the news, they're going to get it wrong again, in our firm's opinion. This inflation will be transitory, in our firm's opinion. Again, what caused inflation was in 2020. Imagine we had $1,000 in the system. Okay, so let's just hypothetically say the United States in general had $1,000 in the system, and there were only 10 goods and services in the entire United States economy. Okay, we know there's thousands and hundreds of thousands, but just for simplicity. So again, you have $1,000 chasing 10 goods and services. Each item, it costs $100. Now imagine you raise the amount of money in the system by 50%. So now instead of $1,000, you have $1,500. Have you increased the number of goods? No. In fact, you decreased them, but let's just say they kept them the same. Each item now, instead of costing $100 for 10 items, would cost $150. The reason the inflation was sticky is you didn't take money out of the system. In fact, I could show you a really easy way to have brought down inflation. Nobody would have been happy, but imagine instead of sending us paychecks to people, we decided to take money from their account. I promise you, demand would have fallen and prices would have fallen as well. So let's take a look at this example, okay? So now today, there's $1,000 in the system, chasing the same 10 goods and services. Now, all of a sudden, one of the goods, I decide to raise the price to $200 because of a tariff. And then the second item, I raise the price because of a tariff to $200. Okay, so two items now cost $200. I cannot buy the last two remaining items with $1,000, because if you're a household and you make $1,000 and you go to Walmart and you buy 10 items every month at Walmart and that's all the money you make, you cannot buy the 9th or 10th item on your list if the price doubled on the first two. Why is that important? What happens to the demand of the 9th and 10th item? It's called demand destruction. Nobody can buy it. So unless you increase the money that somebody brings into Walmart's shop, you'll have demand destruction. So a better example is, I promise you, if gasoline prices, I filled up this morning for about $3.50 per gallon. If prices went up to $10 tomorrow because of a tariff, you know what I can guarantee you happens over the next 30 days? Demand will fall in gasoline, and that's called demand destruction. And what will the price end up doing if you have the same amount of supply? It will fall. If Toyota raises a price by $10,000 for a truck, you will sell less trucks the next 30 days. And then all of a sudden, they have more trucks that hit their lot 60 days from now. And then they have thousands of trucks on their lot. They will reduce the price, and that's what we mean by transitory. So hopefully that explains a little bit. Now, why does Donald Trump Why is he pressuring the Fed, right, to lower interest rates? This is a great piece that shows you we have a Fed funds rate today of 4.33. If you're in a money market right now, you have a yield of probably 4 to 4.25. Here's what we know. The Federal Reserve, because of the jobs number last week, is a 90% chance they will lower rates in September. In fact, they'll lower rates probably again in December, and right now there's a 50% chance they will lower rates a third time by the end of the year. But more importantly, if you look out into next year, if you can see the screen, it says December 9th of 2026. You have a Fed funds rate at 3.13, which tells you the Fed is expected to cut rates 5 times. That's what's being priced into the market today. And more importantly, why? Well, we need interest rates to come down because guess what? We have something called a deficit, right? And if you didn't know this, the interest that we pay on debt today is over $1 trillion. Now, we bring in $5 trillion of tax revenue. We have $37 trillion in debt, but we bring in $5 trillion in tax revenue. And today, we pay about 20% of every dollar we bring in taxes to interest. So, of course, Donald Trump and the president, they want interest rates to come down because we have $1 trillion in interest. But the Fed has a dual mandate. They have employment and they have inflation. Well, if we look at the last 12 months, inflation's been 2.8, above their target. And we have an unemployment rate of 4.2, which is full employment. So that is why the Fed is on hold. Now, the problem with the Fed is they got inflation wrong 5 years ago and 4 years ago, and they don't want to get it wrong this time. Like I said, we think inflation's transitory, so we would be open to a Fed cut. But if you also think about why the government wants the lower interest rates lower, is if you look, this is when our maturity schedule is of United States Treasuries. Now, why didn't we increase the duration of the bonds we issue 5 years ago when rates are zero? We don't have a clue why the government didn't extend maturities. But if you look, the largest maturity, over $7 trillion, will mature over the next 12 months. And if you look, then another $4 trillion in 2026, another $3 trillion. So all of the money, unfortunately, is at the shorter end of maturities. So the government really needs the Fed to lower rates, but the government is who ended up getting us in this issue in general. Regardless, Democrat or Republican, the last 25 years, unfortunately, we haven't balanced the budget. And the Fed will lower rates. That's important for bond securities. If you're sitting in a money market right now, you're getting a yield of 4 to 4.25. We almost have, it's not 100% probability, but a really high probability of rates coming down over the next 12 months, which means if you have a yield in your money market of 4, 4.25, a year from now, it may be 3, and that's important. Talk to Fross and Fross about locking in interest rates because last I checked, when interest rates go down, bond prices go up, and that's a benefit if you're in those types of securities. So let's take a look at the stock market in general, right? Nobody can look you in the face and go, the stock market is cheap in general. And I'm going to talk about different parts of the market here in a minute. But today, the market's trading at about 22 times earnings. It's in the 95th percentile of valuations. Here's the good news. It's all at the top end. This chart basically shows you the S&P valuation by market caps. So if you look at your screen and you see on the left-hand side, it says 1 through 10 on the bottom. That is telling you the top 10 stocks in the S&P. The yellow number is 38.2. That's how much the assets represent. So 40% of the stock market is 10 companies, and we'll go through those 10 here in a minute. But they trade, you see that 29.7? That's the valuation on average of those top 10 stocks. So because it's 40% of the assets, it really skews the price. And if you look at the right-hand side, look at 401 to 500. That's the 401st largest stock, or the 100 smallest stocks in the S&P. They trade at under a market multiple. If you look at 301 to 400, they trade at 15.9 times earnings. The bottom 200 stocks are really cheap in the market. And then I look at other areas, right? So this is your top 10. Everybody, Nvidia's in the news, right? It's a $4 trillion company. Microsoft, Apple, Amazon, Alphabet, Meta, right? Broadcom, Berkshire Hathaway, and so on. But I also started in the business in 1999. And I want you to look what happens over time. Companies change. So my fear is everybody's looking at these beautiful companies, and they are phenomenal. But we can't say they're cheap, right? We've all heard buy low, sell high. Do you know how hard that is? In order to sell something at a high, you have to sell something everybody loves. In order to buy low, you have to buy something the world thinks is the worst company in the world, right? It's the only way to buy low. But I think about, look at this list. So number one is Microsoft, and Microsoft's averaged 10% a year since 2000. It's been a phenomenal company. But look at number two, GE. Do you know over the last 25 years, if you held GE, you've annualized about a 3% return per year. If you look at Cisco, you've ever annualized even less than that, including the dividend, about 2% per year. Walmart's done really well. But look at the best chip company in the world in 2000. It was called Intel. How's Intel's stock price done over the last 25 years? Well, it's only down about 80%. Right? Look at Lucent Technologies. In fact, I grew up in Wheaton, Illinois. It's where our company headquarters is. And right down the road in Naperville, Illinois, was Lucent Technology. Their buildings today are still empty. They traded at $102 a share and went bankrupt. ExxonMobil's averaged about 5% per year. IBM's averaged a dividend 6% per year. Citigroup still down 80% since in 1999, and AOL is AT&T. So my point to you is, over time, the biggest companies change. And my fear is people are just focused on the 10 biggest companies today because today they look really attractive, but let's look out 5 to 10 years and we see a lot of value underneath the surface. What's interesting about AI and the thought of chips being installed, remember NVIDIA, 80% of their revenue came from basically the top 5 companies. And now you're seeing the chips get to other places. And we think that's the next trade up. Think about the small companies in the industrial sector, energy sector, financial sector that finally get to utilize the chips. They can increase productivity, they can increase profitability, and guess what happens after that? Prices usually respond pretty well. Let's take a look real quick at valuations. Now, this is really hard to see, but let's focus on the upper middle chart. And this is called dividend yield. It right now is at the same level it was in 2002. And if you look, dividend paying stocks did extraordinarily well from 2002 to 2012 when the market really didn't do too much. I think about the bottom left-hand corner chart. Now, this is small size companies versus large size companies. It today is at the same level it was in 2001. Well, what happened over that next 10-year period? It outperformed the S&P significantly. And then I think about the bottom middle chart, value companies versus growth. Now, these are more sustainable companies, companies you know that have been around for a long time. They have valuations where they were in 2000, and that's when they started outperforming. So our firm's of the opinion that let's try not to focus on only 10 names. Let's look under the surface where productivity and efficiency and regulations may come down that can give these companies at a 20-year low in valuations compared to the market maybe a leg up moving forward. Again, let's always think about moving forward, where's the best opportunities. Let's not always look at where we are currently. All right, so let's take a look at another opportunity. I know Fross and Fross made a big move earlier this year to add some international. That's another space that we would be looking at. Valuations today, and again, you don't need to know anything about math. All you need to know is 2.5 standard deviations below its long-term mean. It happens 2% of the time. And it usually happens in crashes and usually happens when bubbles burst. And today, this is basically saying that it happens about 2% of the time. And in our firm's opinion, there are great companies outside the United States we want to be investors in. Don't think about investing in countries. Think about investing in a good business that can do business around the world. And the valuation today is 35% lower than the same company here in the S&P 500. So that's where we see as opportunities. So let's take a look from an economic standpoint over the next 5 minutes. All right, from an economic perspective, we got a negative GDP print in the first quarter. Why? Because we had a trade imbalance. Companies knew, or people knew, that the government or Donald Trump would talk about tariffs on April 2nd. So they front loaded. So if you were a business and you bought things overseas, you bought a lot more in the first quarter because you didn't know what a tariff was going to do. The second quarter, however, it was a reverse. We had over a 3% GDP print. Why? Because we had a massive trade imbalance again. This time, more people bought stuff in the U.S. and didn't buy as much overseas. Why? Because now we front-loaded the first quarter and there weren't as many things to buy overseas, and we wanted to support our companies here. So if you look, the GDP print of -0.5 and 3, they averaged, right? 3%, which is 1.5 per year, 1.5% GDP growth. That's what we think over the next 3 to 4 quarters. We probably average 1.5 to 2%. Of course, we have tariffs that are now going to be installed. We still don't know the effect on earnings. And maybe the economy slows a little bit, which you're starting to see a little bit in the jobs market. But at the end of the day, we still have job growth. And what drives the United States economy is the consumer. And I have right now 96% of the people working, in essence, so we have a 4.2% unemployment rate. That is full employment. If you think about back in the 90s, 5% was full employment. Now, last month we created about 70,000 jobs. There was a revision from June and May, but they were still positive. So think of this. What drives the economy is employment. If you start having job decline, right? So instead of gaining 70,000 jobs, we lose 70. Well, last I checked, that means 70,000 fewer people will be able to pay into the system, right? And that's not good. But today you don't have that. You still have an increase in non-farm payroll. So more people are in the workforce than last month. And if more people are in the workforce, they're going to spend. They're going to earn a paycheck and they're going to spend. And I think of what drives the economy is the consumer. If the consumer has a job, they'll spend money. I also think about the consumer. They have the best balance sheet in history. Now, let me segment the different parts of the consumer. The top 20% of wage earners in the United States, and again, we can talk about whether it's good or bad, but the top 20% wage earners today drive 68% of consumption in the United States. So differently, the bottom 80% only drive 32%. Now, we all know the bottom 50% are struggling. Insurance rates are higher. Car insurance is higher. They can't keep up, but they're not who drives economic growth. I think about you sitting there at home. Chances are you have the best balance sheet you've ever had. I think about you have more in savings. You have more in your retirement accounts. You have more in your home, in home equity than you've ever had. And that's good. You're starting with a significantly better balance sheet than any time in history. Think about where you were in 2005 and 2006. And I remember where I was here in Florida. People were borrowing money to buy more houses. They didn't have a a lot of cash. They thought their home would never go down in value. And now you have a fortress balance sheet. You have $7 trillion sitting in cash. So I look at it from a perspective today of I have an economy that's continuing to grind forward. The United States consumer is resilient. Even with tariffs, you still have job creation, jobs growth, which will continue over the next 6 to 12 months, especially with manufacturing coming down. So we look at it from a consumer in a healthy position. And then I think about this. Elon Musk. You know, I think about where I grew up. I grew up in the 70s and the Jetsons were on TV. We have the Jetsons in life form right now. A rocket ship goes up and then it floats down. Why does a Canadian come down to the United States to do this? Because they can't do this in any other country. And then I think about this company called Plenty. Plenty is a vertical farm company. They built their first warehouse in downtown LA in a small part called Compton. They bulldozed down some of the projects that were there, and then they built this vertical farm. Why? Because guess what? In California, they don't have enough water. So a vertical farm uses about a tenth of the water that a 350,000 acre would in a rural part of California. Plus, it saves on trucking costs. And then I think about them growing in the northern part of like Montana, parts of Canada where you can't grow crops in the summer or in the winter, and they can do that. There's no pesticides, using less water and increased productivity. And then I think of this. I think of we are so lucky to be in the United States. We have about 3.5% of the world's population, and we have 21% of the fresh water in the country in that specific circle. In fact, if you include every river, every lake, we have 24% of the world's fresh water. And I think about the people in Asia and Africa where they have to maybe go a day to get water. We live in the greatest country on earth, and the best advice I can give you, put down your cell phone, enjoy life, enjoy retirement. And I just want to say to Fross and Fross, thank you so much for giving me the opportunity to talk with you all today. So have a great day, everyone.
Paul, thank you so much for your excellent insight and for taking time out of your busy schedule to be here with us today. We truly appreciate your partnership and the value you bring to our clients. And to all of you, thank you so much for watching this video. If you have any questions about what you've seen here today, please reach out to your financial advisor at Fross and Fross Wealth Management. And if you're new to our firm, please reach out and we'd be happy to meet with you. So on behalf of all the advisors and the staff at Fross and Fross Wealth Management, it's been a pleasure to spend time with you and share our thoughts on the economy and on the market and how we're working to protect and grow your wealth. Thank you and have a wonderful day.